a discussion with Jenny Kiffmeyer of the Retirement Learning Series. So I'll turn it over to our next moderator, Jeff Cheshier.
Who is he?
Well, thank you, Jeff. And may I say, you're doing an excellent job emceeing. Oh, well, thank you, Jeff. No, let's get on to our conversation with Jenny, please. So Jenny Kiffmeyer, if you do not know Jenny, is, you have probably seen her articles on NapaNet Daily. She writes on a weekly basis?
Correct. Yep.
A weekly basis, one of the preeminent voices on ERISA matters in our industry, and we are very pleased to have her join us to shed some light. So, Jenny, let's start off with what is the latest on fiduciary regulations.
And if you've had a chance to read the headlines today, there's a new one out about that the Office of Management and Budget is going to release the final fiduciary regulations tomorrow at 5 p.m. at a special meeting at the White House. So we are going to see them tomorrow.
Before you describe, does that tell you anything about the timing of that release versus maybe a Friday afternoon or Friday evening release that has been done in the past?
Yeah, well, I think that the timing, everything is about timing with respect to releasing these regulations. And if you have been following them at all, they went to the Office of Management and Budget a month ago. And usually, and the Office of Management and Budget is the last stop on the way to, final review, tidying it all up, and then publishing in the Federal Register. Excuse me. And so they only went there a month ago, and usually that review takes about 60 to 90 days. So when they announced that they were already done within a month's time, plus they skipped some meetings that were planned with some of the other stakeholders in the industry. So they've really been kind of pushing these along very fast. And the reason for that is something that's called the Congressional Review Act. And that's a political tool, basically, that allows any incoming new administration to have a look-back period on rules and regulations that were issued under the prior administration. And if it's done within a few months, then the new administration can basically rescind those. And so the deadline to make sure any new regulations that are coming out right now, that deadline is May 22nd. And so that's why they're really pushing this administration is really pushing to get these out. So in the event we have a new administration after the election, there won't be the ability to rescind these easily, I should say.
Would you say that speaks to their confidence or lack thereof of how the election may go in November?
Let's say they're not willing to roll the dice.
Hedge the bets. Okay. Next topic. So we have heard a lot in the last several months, if not years, about the Secure Act. Yes. Now, everybody wake back up. I know you've been conditioned to just zone out as soon as you hear secure, but it's continuing to evolve. So what is the latest that you are hearing and seeing, and maybe even reading the wind on what's going on?
Yeah. So, if you recall, the Secure Act had over 90 provisions affecting retirement plans. There are really only about a handful of them that are mandatory, and the rest are all optional for plan sponsors to consider adding to their plans. And so within the last 2 months, we've really received kind of a flurry of information coming out. We first received some proposed regulations on the long-term part-time employee rules. That's a mandatory provision that sponsors have to start covering long-term part-time employees. Some would have potentially been eligible already this year, and then Secure Act 2.0 added another level that might be eligible to start in 2025. So we do have some proposed regs there that help straighten out and define and apply those rules with long-term part-time employees. We've also got some guidance on the pension-linked emergency savings accounts. Those are those small balance, $2,500 at the max, accounts that can be associated with a retirement plan, and participants who have those or sponsors that allow those in the plan, that's an optional provision. If they're allowed in the plan, then they have to allow participants ready access to those dollars, but they're capped at $2,500. So it's not a lot of savings, but it is something that can be potentially just earmarked for emergency cases. Then we had the mother load of explanations in Notice 2402. And this covered 12 different provisions in the Secure Act, including mandatory automatic enrollment. So we've got a little better idea of who's considered or which plans are considered grandfathered in, especially in situations where there's a merger or acquisition. There's also more guidance or information on the small financial incentive that plan sponsors can give. That's an optional provision. So they can give this small financial incentive, which we know now is up to $250. So we can know that can be given in a one-time shot for anybody who is not already enrolled in a plan, or it could be spread out over a series of payments so that you could give $100 if they start contributing, 6 months later if they're still contributing, another $100, and then a year if they're still contributing, they can have the final $50 or however they want to divvy it up over that time. Another important one that was in Notice 2024-02 was the amendment deadline. Originally, it was supposed to be by the end of the 2025 plan year. Now that has gotten bumped to December 31st of 2026. That's the earliest it could be. And it does depend somewhat on the plan sponsor, meaning that,
take just a quick step back and talk a little bit more about what is needing to be amended.
Oh, absolutely. I'm sorry. I get on my
Hey, this is exciting stuff.
Yeah,
so
I know it. Yeah, so these are all the amendments that would be required for Secure 2.0 provisions. And so any employer, the mandatory provisions that are required in Secure 2.0, as well as any of the optional provisions that plan sponsors want to implement. So the plan amendments are going to be due by December 31st of 2026, the earliest. There are some further deadlines for collectively bargained plans. It's December 31st of 2028, and for governmental plans, it's December 31st of 2029. But what's kind of interesting in all of this, if you dig into the nitty-gritty, is we're also in what's called a Cycle 4 restatement. So any sponsor that uses a pre-approved IRS plan, that has to go through an amendment cycle every 6 years. And we're in the Amendment 4 cycle. And so all those firms or document providers that write those pre-approved plans have to submit them to the IRS. And the IRS helps out by giving what's called a cumulative list of items that have to be in the plan documents, as well as what's called listing of required modifications. And that listing, or LRMs, they are sample language, plan language, paragraphs that document providers can basically cut and paste and to update their documents. So we do have all of that, but the interesting thing is in the cumulative list from the IRS, they didn't include all of the Secure Act 2.0 provisions. So plan sponsors are stuck a little bit unless we get additional guidance on how to incorporate all of the provisions into the plan documents. So for right now, it's the document providers that are really sweating bullets trying to get those documents written and submitted, because they have to be approved before plan sponsors can actually adopt them. So more drama.
Well, okay, so a lot of the changes that are either in force or are coming online, a lot of the burden is falling on our record-keeping friends.
Absolutely.
If you had to, or do you have a sense that there are any items that, I know they're furiously working on all of these now, are there any that you think there's a decent chance that may get pushed out because there's just not enough time to effectively get it in?
Yeah, now I will go back to the 2024-02 notice that did give us a lot of guidance. One of the provisions that has, a lot of interest, but not much information, was the idea that plan sponsors could give participants the ability to elect to have some of their employer contributions go in on a Roth after-tax basis. And there was a lot of discussion of, how are they going to record keep that? How is payroll going to be involved? So finally, the notice did explain that those contributions will be reported on a Form 1099-R for the individual. So it's really going to be handled at the individual level versus having the employer have to do anything funky with payroll and the W-2s and all of that. So what the participants will have to do is execute a deferral election like they would if they want to make a Roth salary deferral. But this deferral election would relate to their employer either matching or non-elective contributions, designating a portion of those dollars to be Roth contributions. And then the record keeper would need to report that amount in box 1, which is wages, taxable wages, and number 2, what portion is taxable. And that would represent showing the IRS then that this individual has Roth after-tax contributions in the plan. But we still have issues with, what are the notification requirements that the plan sponsor is going to have to provide. We know that there's going to have to be some kind of formal notice that they provide participants so that they know how to make these elections and when to make these elections, how often they can change these elections. So there's still, some murkiness there. But fortunately, we do have a 2-year delay for implementing that. We did get a little reprieve at the end of 2023. So we've got 2 years really to implement 2026. So.
Since this is the last one of our meetings, I'll go ahead and let you know I've tried to throw a couple of questions at you each time that you weren't expecting, and she nails them all. It's awesome.
Okay, what's he going to ask me next?
That keeps it fun. So we have gotten accustomed to opening our NapaNet Daily email every day and seeing 1 or 2 new lawsuits that have been filed. If you've noticed over the past few weeks, there's been a little bit of a change in the nature of a few of them, and it hinges on what plan sponsors have done with forfeiture accounts. So what do we need to know about this new blitz of lawsuits, and how do our advisors need to make sure that their clients, business owners, are protecting themselves as much as possible from any of this?
Yeah, that's really interesting because for those of us in the industry, we were probably scratching, or I know I was scratching my head thinking, well, this is a lot to do about nothing, in that, it's very clear how forfeitures can be used in plans. We've had internal revenue bulletins about them, and plus we just had regulations that came out last year that was they're very clear that the plan can use them either to pay for administrative fees in the plan. They can use them to reduce employer contributions in the plan, or they can divvy them up, a pro rata within the plan among the participants. So those 3, ways of using forfeitures are sanctioned. What these lawsuits hinge upon, and by the way, they all are coming out of one particular law firm, and I'm sure that maybe they thought, oh, we've got the next best thing to jump on board, but I think they picked picked the wrong horse to ride. Anyway, with the forfeitures, their case, what they're saying is that, well, because in these the particular cases, the employer was using forfeitures to reduce employer contributions, that's really the plan sponsor using those dollars for their own personal benefit, because that means that the company then has to put fewer dollars into the plan. So that's really a breach of fiduciary responsibility. But again, we've got clear guidance that that's not the case. The only way that it could be a hiccup for a plan sponsor would be if it contradicts what the language is in their plan document. So that's a very important point, to have plan sponsors review their forfeiture language in their plans and make sure that it covers all three possibilities. Using it for administrative expenses, employer contributions, or giving just more contributions to participants. That gives them the most flexibility and really allows them, to decide how to use those forfeitures. The other thing that kind of went hand in hand with those the forfeiture regs is when they need to be used. And they have to be used within a 12-month period after the plan year in which they accrue. So again, having those three options in the plan really gives the sponsor the best ability to use those forfeitures up within the time that's required.
Well, and it's probably a good idea to have your business owner clients review that plan document on a fairly regular basis anyway, and this can be a good reason to dust it off and take a look.
Right, absolutely. Mm-hmm.
Okay. Well, I know that our Congress is known for how super productive they are in election years. Any new legislation that we might be keeping an eye on?
Yeah, well, I'll start actually with some state legislatures. You're probably well aware of a lot of the state mandates to have either an IRA or Roth IRA, some type of state-sponsored retirement plan for private sector employers that don't have a plan. Cal Savers is probably one of the best known ones. We also have Oregon Saves. New Jersey just came out with their finalized Retire Save, I think it's called. So there's 20 states, I believe, that have...
Right here in Illinois, I believe?
Yes, yep. Illinois is another state. Minnesota, where I'm from. We have a state mandate now as well. So there's 20 states in all that have something. There's only 4 states that haven't at least considered having some kind of plan in place. So the thing is with these state mandated plans, they're primarily Roth or traditional IRAs. So the contribution levels are at IRA levels, which $7,000 this year plus another $1,000 if you're 50 and over. While that's a start, that's not a great amount to try to carry you through to retirement. So what I've been saying with respect to the state plans is, plan sponsors have so many options today to really design a plan that fits their needs. Whether they're small, Secure 2.0 gave us the new starter plans, but we've got safe harbor plans, and even, starting out with a SEP or simple plan might be the way to go. But at least with those plans, it's the employer deciding and designing and really getting something that fits their workforce better than being forced into a state mandate. Or, as we talked about some of the other things that Congress is up to, one of them is a mandatory plan that the government would run. They would create a plan that would require, for those employers that don't have a plan, and they have more than 10 employees, they would have to automatically enroll participants in a government-sponsored plan that the government would run. They'd hire a record keeper for the plan. The government would pick the investment options, probably something very conservative, so that there's no, to try to avoid undue loss. But if there's not a lot of support for this. It's something that comes up every few years, however, and I think it's really Congress's way of messaging to the industry, okay, if you're not going to do something on your own, we're going to step in and make you do something. So between the states and the government, forcing these mandatory, and we got close with, Secure Act added the automatic enrollment mandate for new plans coming up. But so that's one of the government level or the federal government level.
And I heard that the U.S. Post Office is, because they've got declining mail volume, they can just double up the purpose of our mailboxes. So when we have this government federal plan, if we need service or distributions, we can just go to the post office and have that efficient experience, I would imagine.
Absolutely, and pay the extra stamp price.
Of course, yes.
Just a couple of other quick legislative ones. There's also what's called the American IRA Act. Very similar to the state-sponsored plans. It would be something at the federal level, though. This would be an IRA plan that would be facilitated through employers that don't already offer a plan. They just really would have to facilitate payroll deduction into IRAs for their participants. But the IRAs would be managed and held by the participants, not the federal government. And then we have a bill out there that's called Help Young Americans Save for Retirement. And this one would be similar to the long-term part-time employee coverage, stretching it to cover those workers who are 18 and over. Rather than having the age limit be 21, it would drop it to age 18 so that they could start participating earlier. There'd be some breaks for the employer that would put this in place. They would have some tax credits that could apply and some breaks on compliance testing to entice them to put that in place.
Okay. Well, let's stick with the federal government and move to what it might look like come December. What do you think may be on their horizon for the election and potential impacts?
Yeah, it's probably
and a stone cold lock for who's going to be president.
Yeah, that's right. I'm sure everybody's just shaking their heads again, thinking it can't be again. But I believe it's going to be a Trump-Biden head-to-head, and again, there's not a lot of common ground with those two. So I think what we'll see, if it's a Democratic victory, if we keep the Senate and we've got the president in the Democratic realm, I think the fiduciary regulations will be safe, as well as the ESG regulations, the environmental social governance investing regulations that removed that pecuniary requirement. But
there it is. That's our fourth meeting, and I haven't heard you say pecuniary. That's awesome. That's my favorite word.
Yeah, exactly, because that's not part of these regulations. That was the old one. So on the flip side of that, if we have a Republican regime coming in, we'll probably see those fiduciary regulations rescinded under that Congressional Review Act. And potentially, now I think the ESG regs are safe from that, but there's also ways for a new administration coming in to request for another review of regulations and post for comments, et cetera, to start the process of rescinding the ESG regulations, because I think the Republican administration is more interested in reintroducing the pecuniary element of those regs.
Okay. Back to, do you have any more prepared remarks?
Well, there's just a kind of a grab bag of odds and ends of things,
ooh, yes.
Just to let you know.
Poopery, as Alex Trebek used to call it.
Yes, there you go, a poopery. The Department of Labor just recently came out with an announcement saying that they want plan sponsors to help them track down missing participants. This was part of Secure Act 2.0 that the Department of Labor was supposed to put in place a lost and found platform by the end of this year. And so they're asking plan sponsors to voluntarily provide this information to the Department of Labor via their annual Form 5500 filing, which for most will be in July, the end of July, if they're on a calendar year basis. What's kind of funny about this, if there is anything funny about the Department of Labor and IRS, is had they asked the IRS to do this, the IRS already collects this information on IRS Form 8955, I believe it is. So they would have had all the information. They could have built this platform fairly easily and supplemented with sponsor information. But because the DOL does not have the authority to look at those forms that the IRS receives, the DOL has to go through the plan sponsors and ask for their help in populating this database. So again, it's voluntary, and sponsors can attach the information to their Form 5500 filing.
Potpourri for 200?
Yes, there we go. Let's see. Oh, notice 2024-35. If you remember, we had a change to the beneficiary rules a few years back. So if you're basically a non-spouse beneficiary, you could no longer stretch out payments over a participant's lifetime or your own lifetime. You had to take distributions over the 10-year rule. So there was some controversy over, okay, that's fine, 10-year rule, we'll pay it out. Did you have to take a distribution every year? Or could you wait until the 10 years were up and then take a full distribution at that 10-year mark? Well, initially, the regulations would read that the beneficiary, if the original owner of the account was already in distribution phase, so they were already taking RMDs out of the plan and passed away, then the beneficiary under the 10-year rule would have to continue taking annual payments and deplete the account by that 10th year. But because there was so much confusion about that, the IRS has kept pushing it off, and now it's at the 4th year that they've pushed off that requirement. So for the 10-year distribution option, beneficiaries that are under that 10-year rule do not have to take an RMD for this year. They've been pushing that off now for I think it's the 4th year they've done that, until they finally figure out what they're going to do.
We have potpourri for 300.
And our last one, I believe. Let's see. Oh, I did want to bring up, and this is more of a case law to watch out for, and an important topic that the Department of Labor is getting very interested in its cyber security for plan sponsors. A few years ago, the Department of Labor put out 3 best practice notices, one for plan participants, one for plan sponsors, and one for plan service providers to use to familiarize themselves with what are best practices for cybersecurity. And plan sponsors do have a responsibility to protect that personal information for plan participants. And because there's been a few high-profile cases, one in particular happened just a couple of weeks ago. There was a settlement for $8.7 million for a plan that some cyber criminals were able to breach the plan, 2 servers for the plan, and access 100,000 participants and got their names, social security numbers, addresses, et cetera. So rather than fight the case, the company settled for $8.7 million. There had been a prior case where an individual, also her account was breached and lost, I think she lost like $300,000. So there's more case law coming into play here. The Department of Labor, although it won't initiate an audit, for cybersecurity reasons in particular, but if a plan is already under audit, the DOL has been asking for documentation on what the plan sponsor is doing to certify that there is a cybersecurity policy in place, and that all the service providers are also, also have these policies in place. So just I think that's going to be an up and coming area that the plan sponsors need to be aware of, and really put in policies in place, document something for their plan so they've got something in their files, and make sure to safeguard and get help also from a professional, because again, we're held to that prudent expert standard. So if you don't understand it, and I can barely spell IT, so that would be me needing to bring in somebody to be my cybersecurity expert.
Wonderful.
Yeah.
As a reminder, if you ever have any ERISA-related questions, you're always encouraged to send them into what address? support@rpag.com. Thank you. Yes. And we will, of course, we typically have to be very careful about answering specific client situations, but we want to share information with you, help you be able to move your clients' situations down the field, and if you need a referral to ERISA counsel, we can help make those suggestions as well. So with that, we are at time. Thank you very much, Jenny.
Yeah, you're welcome.